You're watching BloombergQuint, and we're in conversation with Shikha Sharma, the head of Axis Bank. It's been a tough 2 years for the banking sector. Axis Bank has not been an exception. We're hoping to understand from Mrs. Sharma what got us here and where we go from here. So, two-part interview, ma'am. Thank you so much. Very, very grateful that you've joined us today.
No, happy to do this.
Ma'am, let me first ask you to describe, as you've seen the last 2 years, how would you describe it?
No, I think, the way you described it is quite accurate. It has been a tough environment, and I think it's been a tough environment for three reasons. One is the changes in the macroeconomy itself, the fact that the capex cycle slowed down, the fact that some of the large projects had accidents and therefore got into a position of creating bad assets both for the promoters and for the banks. That's been one set of problems. The other, of course, has been the evolving regulatory framework, both globally and in India, which every regulated entity then has to adapt to. And the third is technology changes. I mean, there have been rapid technology changes, and they're going to continue for a long time. So that's a lot of change to have to deal with, and when it all comes together, then it can be a bit of fun or maybe not fun.
Ma'am, I think one of the things that stood out for us outsiders is the perception of private banks. We went into this NPA cycle hoping or thinking that the private banks are going to do much better than the public sector banks. 2 years later, at least if you look at the gross NPA jumps, it hasn't played out that way.
Yeah, so, one of the research pieces that I read from a renowned global researcher was that when you look at value creation over a long cycle, it's much more about where you play and less about how you play. So if we look at where the NPA formation has happened in this cycle, it's really come primarily from large corporates. And even within large corporates, it's come a lot from capex formation and large project execution. And as you know, there have been a lot of macro changes which have happened in that space, which have meant that a lot of these projects have gotten into some problem or the other and have therefore not been in a position to service the debt that they took on. And therefore, every bank which participated in that space has gotten impacted in terms of asset quality. So if you look at the pattern, it's not been so much about public sector or private sector. It's really been much more about whether you have been a financier of large capex projects or not, because that's where the pain has come from in this cycle. And to the extent that it's a private sector bank which has participated in that, we've gotten hurt by it as well.
So the risks were not easy to see, or were the risks ignored, ma'am, in some of these cases?
So when you look back with hindsight, you always learn. And I think there are some things that were not easy to see, and the environment changed. And the obvious loud ones around that is the cancellation of various licenses, right? Whether it's the telecom licenses or the mining licenses. Those are risks that would have not been possible to anticipate. I would say that even the dumping of steel, which resulted in a lot of stress on that sector, was not that easy to foresee. So there were some elements which were not that easy to foresee. But again, when you look back in hindsight, you recognize that maybe the system took on more leverage than it needed to. And we didn't have risk participation parceled out correctly. So that's certainly a lesson we've learned from this cycle. And so I think you have to say there's a bit which was outside your control. With hindsight, there was a bit that was within your control, and you could have managed differently.
For your bank in particular, ma'am, do you think you paid the price in part for growing a little bit too rapidly?
So if we look at growth era, I joined the bank in 2009, and given that it was a relatively small private sector bank, it had actually been growing at 35% plus. We actually have slowed down growth ever since then, and it's been the mid to high 20s, and then narrowing down to the 20s. So it's a question of smaller banks will grow faster, larger banks, just because the scale will slow down their growth, even though it could be industry beating growth. So I would not say it's because of growth, because we have had high growth in certain other segments as well. I would go back and say it's more about where we played. So we had traditionally been a corporate lender, and we continued to see growth in the corporate book. And again, traditionally we had been more of a term lender, and we continued to do that business. And that business is what has caused pain for the entire sector and has caused pain for us as well.
Okay, and I'll ask you a little bit about how that changes in the next cycle in a minute, ma'am. But sure. On this perception theme, the other thing that has happened more recently is this issue of divergences.
Yeah.
I mean, I think the regulator is saying that we haven't changed the rules. Banks were simply not, adhering to them in letter and in spirit. And, for the first time, we're seeing the regulator actually penalize some banks for, not adhering to IRAC norms, which is rare. Where is that issue coming in from? From the banker side, what is the what is the issue?
So I don't want to debate that too much, Ira. I think a lot has been said on that issue. The regulator themselves has clarified that, look, divergence is part of the whole inspection process of RBI, and that's where the number comes from, and it's done every year. It's just that there's been a change in regulation which now requires it to be disclosed, whereas earlier it was confidential, wasn't required to be disclosed. And yes, as I said, we have an evolving regulatory environment, and I think we're all changing and learning as we go along.
Is it under-reporting or not? I want to, because all of us on the outside are seeing it as under-reporting of bad loans.
I don't think I want to debate that issue technically. Okay. I think let's just take it as it is, that the bank reported a set of numbers, the RBI inspection threw up a different set of numbers. That's what it is. And as RBI themselves clarified, I think post the last monetary policy, this is an ongoing process. So we'll have to see how it pans out in the future.
Sure. Ma'am, now two things that have happened in the bank in particular, from a management standpoint over the last 12 months is, one is that you've been reappointed for 3 years. Yeah. The reappointment came, well ahead of your term, which was due to expire in June, I think, next year. What was the reason for that? I mean, because, at that point in time, there were lots of rumors, speculation doing the rounds around the bank, whether it was you and whether you would stay on, or it was, whether you were an acquisition target or not. At that point, why did the board and why did you decide to sort of, sign off on that line?
So I think, if you look at any large institution, and especially a regulated institution, I think it's important to have orderly succession. And typically you would see large organizations announcing succession a year in advance. So it shouldn't come as a big surprise that the Axis Bank board chose to do that as well, to make sure that you kill any uncertainty in the marketplace in terms of what's going to be the leadership structure and where the organization might go.
So the context at that point was not important to the appointment, because all of us saw it as an attempt to sort of, quell the speculation around the bank and its leadership.
No, Ira, actually we've had an ongoing succession discussion in the bank for a long time. And we've had a succession process. We have it both at the board level plus at the executive level. And I would really reiterate that this is part of that whole process. And the board had been in discussion. In fact, there was reports that the board used external consultants as well to look at the whole succession process and take the decision. And I think that's really best practice anyway. And I guess when they reached a decision, they made the announcement. So when you put a succession process in place and that becomes public, then of course, given our marketplace, we love rumors and we love speculation. You have a lot of speculation around it. I think it's inevitable if you have a succession process.
Okay. The other thing that's happened more recently, ma'am, is the capital raising plan that got finalized. Again, there was never any doubt that Axis will get the capital as and when they want it. But you got in some marquee investors.
Right.
Was it more confidence capital than it was growth capital or regulatory capital?
So, all of this terminology, I don't understand.
It's my terminology, so I'm very proud of it, but I want you to tell me if it's right or wrong.
No, so I don't want to debate any of this terminology stuff. But, if we look at it, again, I've been in the bank now for 3 rounds of capital raise, right? Okay. And I think the bank has been very disciplined about its capital raising, and we've been fairly explicit in saying how we do our capital planning. So every time our strategy has been to try and raise enough capital to be sufficient for a 3-year period, because we don't want to have to come to the market too frequently, and yet we don't want to have a lot of excess capital sitting around the books and not returning returns to the shareholder. So that's been a consistent process that we have used every time. And the second thing that we have consistently articulated is that we would like to keep our Tier 1 threshold higher than the regulatory minimum. And we've articulated again that, once the Tier 1 hits around 9.5–10%, we believe it will be time to look at a capital raise, because we do want to keep that kind of cushion for any growth or any other events that might happen. So having hit 10.95% in the last quarter, it would have been time for us to start thinking about a capital raise. Plus, with the whole impending discussion around Ind AS, is it going to come, is it not going to come, and what's going to be the implication of Ind AS, plus the whole PSU bank recap, and therefore the thing that a lot of banks might go out to the market to raise capital, it looked like it was better to go ahead rather than behind. So that was the whole thinking around raising capital at the time that we did. And the amount, as I said, was decided very much consistent with what we have done in the past, which is planning for capital for the next 3 years. Now, if that creates confidence, because we get a good set of investors to come in and invest at a price which is at a slight premium to the market price, we're not quibbling with that. That's fine.
Collateral benefits.
Collateral benefits.
I remember that allows me to segue into what sort of comes up ahead. Now, I think for the first time in the financial stability report that the RBI put out, they talked about the bottoming out of the cycle. I know that bankers have been very cautious in the last few quarters, having sort of run ahead and said it's over, and then it wasn't over. So as you stand now, sort of how do you see for your bank the cleanup process? Near the end, at the end, close to the end?
So, the recognition cycle, and you're right that, we've said that, okay, we're kind of, the hump is behind, and then we still have some surprises that come through. So it would be difficult for anybody to come and say, yeah, it's the end or it's nearing the end, because you don't know what can come in. But having said that, I think we've seen 2 years of an elevated credit cycle. And since I think close of FY12, we as a bank took stock of where we were lending, and as I said, much of our pain came from where we lent, right? We were corporate lenders doing term lending to projects, and that's been the key source of pain. And post FY12, we actually moved somewhat away from that and moved more towards operating companies and the higher rated companies, less project finance. So if I put the combination of the fact that since FY13 onwards, we have been shifting where we've been doing our corporate lending. The last 2 years have seen elevated credit costs. I think you have to see that at some point this thing is going to end, right? Is it going to end in 2 quarters? Is it going to end in 3–4 quarters? I think let's see how it pans out. I don't want to be very definitive about that.
But the growth process is back simultaneously. I mean, I know retail has been growing, but
the corporate growth
cycle.
So I think in the corporate growth cycle, again, there have been 3 factors. One is the capex cycle has been weak, because there's been a lot of this capex which has gone and got stuck and is unproductive. So a lot of people, their focus would be to go and acquire some of these stressed assets, make them productive rather than start a new capex cycle. Then you had the whole issue of WPI deflation or very low inflation, which meant working capital requirements got suppressed as well. And you had the third issue of a lot of liquidity in the system post-Demonetization. So borrowers actually going to the market rather than coming to the banking sector. As I see it from here, 2 of those things will likely change. One is you're seeing WPI inflation in positive territory, so working capital demand will come back. 2, with liquidity getting constrained, I think we'll see more of a balance and going back to borrowing from banks and not just from markets. So I think you will see growth in corporate credit, and we're beginning to see the first signs of it. Capex cycle, I think, may still take a bit of time, because, as I mentioned, people who have cash would rather go and buy a stressed asset and create value from that rather than do a greenfield project at this point of time. But I think I would watch the government's budget announcements as well, and if the government is going to push ahead on capex, and I think that may create incidental small pieces of capex in the private sector as well. So we're generally positive that corporate growth should look better, maybe low double digit, maybe high single digit, but But I think it should certainly look better than what it's looked in the last year.
Will you lend, will you do project finance in a big way in the next cycle whenever it does pick up?
So I think we've burnt our fingers. We have learned lessons from one, concentration risk, two is structure of the project and risk parceling, and through is leverage structures. So I think we would keep all those in mind as we think about project lending in the future. So it's not that we're not going to do project lending. I think we would just be a lot more careful about the sectors and the kind of unknown risks that we might get exposed to. We would be careful about sponsors, and we would certainly be a lot more cautious on leverage structures. So the preference would be to lend to companies with operating cash flows and to do project finance selectively, depending upon all of those parameters.
The retail wholesale mix for the bank, ma'am, is it more or less stable, and would you like to see it at this level?
So actually, we've been finding that consumer lending demand has been growing faster than corporate credit demand. That continues to hold true even today. And with increasing digitization and more movement from the informal sector to the formal sector, I do think that you'll likely see more growth coming from consumer and small businesses. So the retail segment, which today accounts for 44%, and along with SME, retail plus SME is about 58%, I think that could continue to grow larger as a percentage of the balance sheet, although the pace of change might be slower than it's been in the past.
Okay. Now, I'm curious to know what happens in the next lending cycle, or at least what you think will happen, from two perspectives. One, a lot of the promoters who banks lent to in the previous cycle are either stressed, over-leveraged, or have not, given banks the best experience. Do you think newer promoters will emerge who will take the next investment cycle forward? And if not, if it's the same set of promoters, will banks be reluctant to lend to them, given that probably memories will be fresh?
We've seen a set of promoters who have created investments in the past. So if we go back and look at India's history of 100 years, you will find different promoters in different parts of the cycle, right? Some of them have ebbed and flowed, so they've been more important in one part of the cycle, and then they've slowed down in the other. And I think some of those might come back in the next cycle. So I think India has no dearth of entrepreneurial talent, the people who will participate in growth in the next cycle will be the ones who have a demonstrated track record, both in terms of technical execution as well as financial discipline. And I continue to be extremely optimistic about our economy. If you talk to global investors, they continue to be extremely optimistic about our economy. And that comes from the demographics, but it comes as much from faith in Indian entrepreneurship. So I think we will find the right promoters to grow this economy.
Besides, now you have the IBC, and at least the early experience with IBC suggests that they are doing a little bit of he's managing to do a little bit of arm twisting, if I may not be the right word, to promoters. So banks may actually be sort of slightly more confident lending into, say, the corporate cycle if it picks up, if the IBC experience proves to be positive.
So I think the good thing about IBC, and actually bankers have been asking for a faster resolution process for a long time, is that it helps promote a stronger credit culture and stronger credit discipline, and that can only be good for growth. So you've probably heard me say this before, but the best thing that happened to the consumer credit cycle was the creation of the credit bureaus and all the regulatory focus on how collections should be done, because that suddenly put the focus back on portfolio management and underwriting, and from a borrower's perspective, it put the focus back on being disciplined about your borrowing. And that meant that people lent more confidently and the borrowers were more conscious. And I think that could well happen in the corporate cycle going forwards from here, with the amount of regulatory change that we have seen from RBI, with the whole new Insolvency Act, with the availability of credit data. I think we're now operating in a different world, and I do think you could have more confident corporate credit lending going forwards.
Ma'am, I want to move to the third part that you talked about when you talked about the three things that have been changing over the last 2 years, and that's the digital part. Access has been sort of doing a lot on that front. I want to two parts to it. One is, how is your bank sort of adopting to all of these changes that are happening, particularly on the retail credit side? I mean, there have been places where we've said that wallets are going to take away some part of the payments business, etc. There are payment banks now. How is this digital change playing out for you?
So we've been investing in the digital stuff for a few years now, actually. One which you see externally and what we need to do internally. Internally has been around redesigning our processes and digitizing our internal processes. Because if you don't do that, then you can't actually deliver a digital experience at the front end. So I may have a great mobile app on the front, but if it can't get anything done, then it doesn't work. So I think that for us has been at least a 6-year journey about relooking at our internal processes and digitizing them. And I think we would continue to do that. I won't say that it's the end of that journey. And the rest has been looking at new offerings, both from a service and product perspective, to use technology to give a better experience to customers, whether it's in the way you transact for service requests. Today, a lot of the retail customers are actually moving to the mobile, so the mobile experience becomes important. Or even the way we acquire customers for lending products or cross-selling investment products. I think you can use technology a lot for that, and we're certainly focused on doing that.
But none of these, there was a point in time when there was a fear that, some of these newer entities would sort of eat into the bank's business.
Yeah.
That hasn't, at least so far, it doesn't look like that's happening, right? The payment banks, no clear indication of how successful they'll be. The wallet guys are, sort of in the middle of transition on regulation on their front as well. So it's not like they're eating into the bank's business in any way.
So I think we have to say that, to be fair to the regulator, they have also, moved ahead and said that, look, they don't want regulatory arbitrage. So if you can do one thing in a particular way, the payment bank, you should be able to do the same thing the same way with a bank in terms of the KYC processes or the two-factor authentication processes. So then you have a level playing field, and then it's really up to every entity whether they have invested enough in tech process and product capability to be able to compete for the mind of the customer. And I think a lot of the banks have focused on strengthening that capability and being able to offer a customer proposition. And the fight will always be for the customer. And I think in this fast-changing world, I wouldn't say nothing is happening. Who knows? Tomorrow's a different world. I think you will see shifting market shares, and the consumer will decide who they want to go with. So for every bank, it's really about trying to understand what the customer needs and making sure we're continuously looking at our processes to be able to deliver that service and value to customers.
What about this whole push towards digital transactions, move away from cash? If you look at the macro numbers, it doesn't look like it's been. I know digital transactions have gone up, but currency in circulation, is now, I think it was 12% of GDP before demonetization, is now 11% of GDP. So one wonders whether there is actually a shift or not.
I can tell you from our own numbers that we are finding quite a significant shift. So cash is almost becoming stagnant, whereas digital is continuing. And if we look at global economies, I was in Singapore in 1997, and they had a fully digital payment system at that point of time, NETS. They were one of the first adopter of doing that across the country. But even today, Singapore uses cash. It's not that cash has gone away. So cash will not go away. But as long as cash becomes a smaller and smaller proportion of transactions, that's what you can hope to achieve. And we've certainly seen that happen. So digital transactions are now close to 70% of the total transactions that a customer does with us. Another interesting statistic is, before Demon, for every debit card transaction that a customer did, 2/3 was a cash withdrawal and 1/3 was a transaction at POS. Okay. And today that number is more than half a transaction at POS and less than half a cash withdrawal. So it's changing, and this is a short period. So to see that dramatic shift in a short period, I think consumers adapt to technology.
That's an interesting statistic. I'm just closing off the conversation with your sense of where we go in 2018 for the economy. There have been disruptions, but then there have been some things that have been fixed, like the IBC, like the public sector bank recap, etc. What's your broad impression of what 2018 could look like?
Bankers are always optimistic, so I should put that disclaimer out front. But
they haven't been too optimistic last 2 years.
I think we've been chastened, but inherently still optimistic. So I continue to be optimistic, however cautiously. I think there are lots of good things happening. The US is growing well, Europe growth is coming back. So global growth looks like in a positive place. If you look at India itself, I think we've had some major structural reforms, and some of those reforms may cause short-term pain, but they're very good for the economy from a long-term perspective. And I think one should expect to start reaping the benefits of some of that structural change going forward. I would expect that there would probably be a focus on the rural economy over the next year or 2 years. Everybody is expecting that, which should fuel consumption as well. And the third piece that I would put in there is this whole IBC resolution, because if large projects are stuck, then it's just visible signals which cause lethargy and despondency. Now, if some of those assets are made productive through this whole process of a resolution, I think that's great for the economy, and that will certainly have a lot of spin-off benefits.
Unless there's large-scale liquidation, which you're not anticipating? I
think for any asset which has real value, I don't expect liquidation to happen. If we look at some of those large projects that are currently under IBC, I'm sure a lot of them are going to find buyers. So between the changing global growth scenario, the positive impact of some of the structural reforms, the positive impact of resolution, and the government's own focus on driving growth, I would think that 18 should certainly be a better year than 17.
But we'd be in a rising interest rate scenario. As I was coming, I think Kotak raised rates on retail deposits as well. So we are entering into a rising interest rate scenario?
I think we've certainly seen the bottom of the rate cycle. So I don't think we're waiting with bated breath for another rate cut, but rising rates, we'll see how it goes. It's such a fast-changing world here. It's hard to say. Right now the whole sentiment is oil prices are going up, so inflation is going to go up, so we're going to get a rate hike. But tomorrow, if oil prices stabilize, then maybe we'll say, okay, it's probably going to remain stable. So who knows? A year is a long time.
In the middle of 2018, and hopefully we'll have another chance to chat with you. Thank you so much, ma'am. Appreciate your time today.
Thank you. Thank you, Ida.